Hello and welcome back to the fixed income securities series of NISM. Let's continue with the next chapter, that is chapter 2, types of fixed income securities. The learning objectives of this chapter is classification of fixed income securities based on type of issuer, classification of fixed income securities based on maturity, classification of fixed income securities based on coupon, classification of fixed income securities based on currencies, classification of fixed income securities based on embedded options, classification of fixed income securities based on securities and other fixed income securities in India. A bond is a financial security issued by a legal entity to raise funds from the financial markets and agrees to refund or return the borrowed amount principal at the end of the contract period or at various time intervals as given in the indenture along with the promised interest or coupon. Agreed annual interest promised by the issuer on the bond is generally referred to as a coupon. A bond is akin to a loan with a maturity and coupon rate paid at various intervals, based quarterly or half-yearly or annually. However, it differs from a loan mainly with respect to its tradability. A bond is usually tradable and can change many hands before it matures, whereas a loan usually is not traded or transferred freely. A loan brings permanent risk to the lender till the loan is repaid, but the bond holder can transfer his risk to the other takers through efficient pricing mechanism. The value of the loan does not change, but the value of the bond changes on continuous basis depending on future interest rate regime in the economy as well as credit worthiness of the borrower. While bonds can be classified in many ways, for ease of understanding, the basic classification of bonds can be considered based on the following criteria: based on issuers, based on maturity, based on coupon, based on currencies, based on embedded options, based on priority of claims, based on purpose of issue, based on underlying, based on taxation. In this unit, we shall discuss the various classifications of bonds based on their inherent features. 2.1 classification of fixed income securities based on the type of issuers. The borrowers of funds who borrowed by the way of issuing of bonds are called issuers. Bonds are usually bought for their riskiness based on the issuer's profile. The value of the bond mainly depends on the ability of the borrower to service the debt obligations as per the bond indenture. Chapter 2.1.1, Government bonds, sovereign bonds, and gilt-edged bonds. So a sovereign bond is issued by the government and is typically denominated in the domestic currency to support planned and unplanned expenditures. Government bonds are also known as sovereign debt and are generally issued via auctions and traded in the secondary market. Government bonds issued in local currency are considered risk-free as the government, being a sovereign entity, can print the currency to repay its obligation to bondholders. However, as demonstrated during the European debt crisis 2008 to 2012, governments may also default in debt payments in case of an emergency situation. Because of their relative low risk, government bonds typically pay lower interest rates than the bonds issued by other issuers in the country. In India, government bonds constitute the largest segment of the fixed income market. This also includes the securities issued by the various state governments and union territories, which are known as State Development Loans (SDLs). Indian government securities market GSEC also includes the special securities issued by the central and state governments in India. Special securities are issued by the government for providing various subsidies like oil, fertilizer, bank recapitalization, etc. Chapter 2.1.2 Municipal Bonds. Local authorities may also issue bonds to fund projects such as infrastructure, libraries, or parks. These are known as municipal bonds and often carry certain tax advantages for the investors. Municipal bonds are also known as mini bonds or a municipal bonds is a municipal bond is categorized based on the source of its interest payments and principal repayments. For example, a general obligation bond (GO) is issued by governmental entities and is not backed by revenue from a specific project, but rather by the credit and taxing power of the issuing jurisdiction. Uh, GO bonds are primarily used to subsidize the development of public projects. On the other hand, a revenue bond is category of municipal bonds supported by the revenue from a specific project, such as a toll bridge, a highway, or a local stadium. Revenue bonds that finance income-producing projects are thus secured by a specified revenue source. In India, while very few local authorities or municipal authorities have issued such bonds, the market is gradually picking up. The Ahmedabad Municipal Corporation was the first municipal corporation in Southeast Asia to raise money through public issuance, when it had raised 100 crore through this route in 1998. That's it for now. We will cover the next part in next video.